So yeah, great to see everybody. I've done this session or similar sessions several times, and hopefully I'm learning little by little how to optimize it. Um, but basically what I'm trying to do here is to give you a feeling for the investor mindset from the perspective of a finished pre-seed or seed funded company. So meaning, or either unfunded or pre-seed. So in other words, if you're looking for either get your first or second round of capital, I think it's really important to understand the way the investors look at things. I've been through several life cycles of the Finnish startup community. I started in venture capital all the way back in 1999. I'll tell a little more about that in a moment. But today I basically am a partner in 3 different funds and then have some of my own investments. So a total of about 50 investments in pre-seed, seed, Series A companies in Finland, the Baltics, and in Eastern Europe. I'm originally from the United States, from the East Coast, Virginia. Lived a lot of time in North Carolina, and I'm actually an adjunct professor at the University of North Carolina as well, teaching venture capital and finance. In the sectors that I invest in are primarily health tech, ed tech, education technology, environmentally related digital technologies, and then of course anything else that kind of looks interesting. And I've, as part of these several different funds, I've made during the COVID period, I've been part of about 55 investments now. So still very active and feel like I know the current climate pretty well. So what are we going to try to answer in this session? So I would be disappointed if at the end of this session you will not understand these kind of something about these 7 issues. So first of all, what a fundraising strategy really is, and there are many different levels to it, but I think I can help you think about that from your personal perspective, your company's perspective. Who is your ideal investor? I think, one problem startups have often is they too much kind of give in once they run into somebody that has money that's ready to put into the company. They don't realize that maybe the visions aren't perfectly aligned. And so they take the money and then they start paying for it 3, 6, 9 months down the road when your kind of strategy and your as the founder, your approach and goals diverge from the investors. So very important to think about what this investor looks like. So I'll share some stuff with that. How do you track a fundraising process? Fundraising, you'll see me over and over. It's really a selling process more than anything else. So it's, if you sell a product, that's one thing. Here, you're basically selling your shares, selling your company to investors. So it just like you have a CRM for your sales process, you should also have a CRM and really track and look at the metrics of your fundraising process. So that's another thing I'll talk about. We'll look specifically who are the active Finnish investors and look actually at a number of recent deals. What do deals in Finland look like, both venture capital and angel backed? What are investors looking for at the end of the day? That's something we'll come back towards the end. Four objectives of the session, it's going to be loosely related to those 3 sections, because we're going to look at the fundraising workbook at the end in more detail. But first I want to start with motivating how to fundraise, how to think about fundraising. Then I want to talk about the investor mindset. That mostly is probably going to come in the second session. And then really more practically about the material and stuff that you need to prepare as a founder. Background, mindset, super important. Defining the targets, meeting the right people, which is super tricky in COVID times, but also funny enough, in a way even more possible than it was before. Using the right tools, preparing physical and digital material. So, again, we're getting more and more digital with COVID, but you still need to think about, kind of also having materials at your disposal that you can share when you meet people face to face. And then, all this comes together in your ability to deliver a pitch in a bunch of different contexts, one-to-one, on the stage, in a small group, at a cocktail party, whatever. How to kind of pull your story apart to make it have the optimal impact on the investor. The big picture here, fundraising is more about strategy, art, and philosophy than math, science, and finance. Now, the reason I say this is because your way of strategically finding and bringing along and onboarding an investor, or much more than a scientific kind of undertaking. You have to have the math, science, and finance. So at the end of the day, you have to have some projections about what you think your future is going to be. You're going to have a cap table with, how much percentage everybody's going to get. There's going to be math, science, and finance there at the end of the day. But nobody ever got investment. You're never going to walk into an investor and say, I'm going to give you 100 times your money back. And that's going to be the thing that the investor says, oh, wow, here's the money. Never happens. Much more about do we share a vision? And so in that sharing a vision is strategic and really philosophical, in my opinion. And I'll dig much deeper into that. All right, here's a typical kind of flow chart, or kind of general kind of image people give of fundraising. So, and this is at a very high level. So, and I'll get to my comment here. If you think of this way, you'll never make it in a moment. But basically, so in a vacuum, this is true. You start by making an introduction and connecting to an investor. You definitely want to use networks. You definitely want to avoid cold calls. No doubt about it. You want to get warm intros. Very true. Hopefully it'll lead to a meeting. First few meetings, it's only about kind of prosecuting forward, getting multiple meetings. After 3 or 4 meetings, you start, the investors really starting to focus on things like, who your team is, what's the size of the opportunity, seeing if you can start sharing a vision with the investor. After that, once they kind of give a kind of a oral kind of yes or oral commitment, you'll get to things like determining evaluation, talk about in a minute. You get a term sheet, something that kind of dictates all the terms. And then after that, you'll build a shareholders agreement and investment agreements that will kind of define everything about how the money goes in, how the company's managed, et cetera. Once you kind of agree on this, in this due diligence process is kind of ongoing. We'll look more at that in a moment. But there'll be, depending on how big you are and how big the money is, there'll be some layer of kind of business due diligence, legal due diligence, financial due diligence. In pre-seed cases, often this is like a day of just sitting down with the founders and going through contracts and talking about the business, looking at any of the kind of company foundation papers, et cetera. But if you're talking about hundreds of thousands, millions, then it'll take more time, several weeks anyway. And then finally, the funds released. So yes, this is in a vacuum, the kind of linear approach to fundraising. But if you sit back in the beginning and say, I'm going to do this now 100 times with different investors, you can imagine how time consuming and frustrating it gets as a founder, that you're just thinking of your process in this linear dimension with 100 different players that are going at different speeds, have different layers of desire for the investment, et cetera. So while this is a good kind of process, it should not guide your strategy of fundraising. So what I use for fundraising is what I call the fundraising model canvas. It's a total knockoff of something that you've seen probably before, hopefully. And if you haven't, you should see it soon. It's called the Business Model Canvas. And so you may, if you're anything like me, I saw the Business Model Canvas first time in 2009, 2010. Actually, Steve Blank came to Finland and he kind of went through the logic of the Business Model Canvas. But what struck me, when I was frustrated with, actually my frustration is I have so many companies that are different stages of fundraising. I wanted to come up, I started thinking, I said, hey, we could use this as a tool for thinking about the fundraising process. So let me kind of walk you through my thinking here a little bit, and without going into a lot of detail, but general thinking here. So, and I'm just going to look at the right side. So if you've ever worked with Business Model Canvas, this is kind of the value realization side. This is a value creation side. We're going to think about first the first thing we think about, you always need to think about, is how much money do you need? And that's an interesting question, because and I always put it in two dimensions. The first thing is, how much money do you need now to get you through your next critical milestones in the company? So if you're working on your MVP, how much do you need to get to the kind of get your MVP totally finished? Then how much do you need to get to the first customer ship? How much do you need to get to kind of scaling, internationalization, whatever? You'll have different milestones, but in general, this kind of amounts to, how many milestones do you want to kind of accomplish in the next 12 to 18 months? How much money do you need for that? So that's the first critical kind of assessment, is how much money do you need now? Second critical thing is, how much money in your kind of best vision of the future do you need before you become profitable in a growing company? So let's say you might need $1 million for, to get through these first few milestones and survive for a year to 18 months. But then, to become profitable, you probably are going to need, you may well need multiple funding rounds. And I, as an investor, am critically interested in your vision of how much money you're going to need over time. There's no right or wrong answer to that. It could be you don't need any more money. You only need the pre-seed and you will get to profitability. That happens sometimes. Or you might need $100 million. So there's widely varying, but this is important to share the vision with your earliest investors, how much money you need now and how much money you'll need over time. Then when you think about the value proposition to investors, you need to think about, what benefits do you provide over your competition to that investor, and who is your competition? So we're all very tuned in to our product market or service market competition. That is not necessarily, and usually is not, your competition to when you're raising money. You're competing with others going to that investor, and they will have widely different businesses, business models, industries than you're in. So you need to think about, why, when you look at an investor, what is it that you bring to the table that's kind of more interesting than everybody else? Because the assumption is that everybody that walks in that investor's door is going to have the 10 times money back kind of message. So that's almost a commodity. And that will be checked clearly as you kind of develop your relationship with the investor. But it's not a differentiating factor. What I think is differentiating is if you do your homework on the investor. I'm going to give you some ideas on that in a moment. You do the homework with the investor, you understand what they're looking for, what their experience is, what their skills are, what are the things that they will kind of bring, that they can actually bring to the table to you beyond money. And that's where you start kind of connecting and making them kind of start saying, okay, I'd rather put money in your company than this other random company, even though you kind of look like you're going to have the same, potential success. So that's kind of the first thing. Second is, who are the investor segments you're going to approach? Angels, super angels, venture capitalists, corporate investors, crowdfunding. There are certainly others out there. I'm mainly here talking about equity capital. So I'm talking almost always in Finland, you're going to be thinking equity and grants. So thanks to Business Finland and many others, several others, EU, et cetera, there's often chances to get huge loans and huge leverage for the equity investment. But here we're just thinking about people that you're willing to sell shares in your company to. And so pre-seed and seed level, generally you're thinking angel, maybe super angel. Definition of an angel is in Finland is somebody who's willing to invest up to say 100,000 euros. And then I would call it super angel in Finland, people that are individuals that are willing to invest more. If you go to the US, to, different parts of the world, you'll find very different definitions of that. But in Finland, what you'll see is basically the average angel investor will invest 20 to 40,000 euros in a company per company. So, if you're raising, for example, raising 200,000 euros, you're going to have to go to multiple regular angels to get that round done, or you find a super angel, somebody who invests more. I'll give some links to Finnish business angel networks, but Finland has one of the best angel networks in Europe, really in the world, I would say, in terms of tools for entrepreneur to help you learn, how to pitch to them. And I'm going to share some stuff with that. But you want to figure out what the kind of segments you want. How do you get your message through them through the first time? And that's where the networking comes in. Maybe it's kind of obvious, but I mean, most deals fail. Most deals fail because the right investor never discovers your company. So how do you reach out and make sure you're visible to the widest audience of angels, VCs, whatever, that have specific interest in your area? That requires research, that requires, physical networking, digital networking, et cetera. So we'll talk some about that, but that is, to me, at the end of the day, what keeps me up at night is I know every company has 5, 10, 15, 20 investors out there that would love to put money into you. But if they don't know you exist, then it never happens. And then once you get, obviously get the message through to the right investors, how do you retain the momentum? How do you keep them kind of moving forward through that linear process I talked to? Because once you get them on the hook, then you're really back into that linear process I showed earlier. So kind of case by case, you're here, but when you're kind of planning your strategy, you're here trying to kind of optimize the whole thing. The company was spinning out, keep in mind, 2 founders, about 150,000 euros of grant money. They built an MVP, basically. It's a web application, not to go to detail about that. We started pitching, and in Finland, to angels. And we found an angel that was ready to invest 50,000 euros to own 20% of the company. So here's the first mathematical concept. Most of you probably already know this, but there's a distinction between pre-money valuation and post-money valuation of a company. So here, if 50,000 euros is going to own 20%, that basically means that the post-money value, the value of your company after the money is in the bank account is 50,000. Sorry about that. 50,000 divided by 0.2 or 250,000, right? So 50,000 is 20% of 250,000. So that's the post-money valuation of the company. And then when you calculate what the pre-money valuation is, you just subtract off the money that came in. So the intrinsic value of the investment, the company was 200,000 euros before the money came in from this investor's eyes. So we were kind of, it was okay, it was interesting, but at the same time, we thought we might be able to get some better bids. So 3 weeks later, the company traveled to the US, was in Silicon Valley. Definitely, I'm not saying this only happens in Silicon Valley, but the differentiation is between a local investor in Finland. Then in Silicon Valley, the team pitched and got to a super angel in the Valley who was ready to invest 1 million euros to own 20%, making the post-money value 1 million divided by 0.2 or 5 million euros pre-money value 4 million euros. So, so you've got a huge difference here. So the same company, I don't know why it's like that. Same company, same exact idea. To one investor is worth 200,000, and the other one is worth 4 million. 20 times more money, worth 20 times more to this investor than this one, and this one is willing to put 20 times more money in. So 20 times more valuable and 20 times more money. Obviously, we took this investor and sealed that deal and kind of went forward. But the point here is that when you think, entrepreneurs think about the value of your business, you think about other things than, you know, I think most entrepreneurs are surprised that, you know, there can be this 20 times difference depending on who's looking at it. But the difference is simply, this investor actually is a Danish investor, so it's not even a US investor. He was just residing in the Valley at the time. He foresaw a huge market for the product. He was aligned with the founders who also had a large vision, and they agreed that, you know, with €1 million, they could grow this company a lot faster and have a higher kind of end potential. So kind of by definition, they sat down and agreed that the kind of application that they've already done was worth 4 million versus this local investor who's also quite rich guy, but in his mind, he didn't have the same type of a huge vision. So this is why I always get to this, if you don't get to your optimal investor, you may leave a lot of money on the table. That's actually a minor thing, but you actually may miss that huge potential because simply you're not aligned on the same vision. So that's a little bit of math. And again, for any of you that were looking here to do a lot of complicated math, that's not what this is about. But this gives you a little bit of an image why your strategy that you set up back here needs to be able to reach out to a larger audience than maybe just the Turku crowd or Oulu crowd or Tampere crowd or Helsinki crowd. But maybe you should think more in terms of globally, who are the people that, and both people and investors that are interested and find ways to get into that. Now we're going to dig a little bit deeper and just thinking about, okay, we look kind of at process from your side. Let's try to look at what really makes investors tick. One of my favorite subjects. I've done a ton of kind of research on this in different contexts, but this is a good way of thinking about it. So basically, every investor has a set of attributes that they're looking at. And that's where in the third session, we'll look at the workbook. That's where I think the workbook helps you kind of diagnose this. This is one of probably the top 5, top 10 venture capitalists of all time. His name is Tim Draper. And this is old, very old. It says he has 103 investments in 77 companies. I bet he has 1,000 investments through various funds, also directly. So definitely, you know, multi-billion-dollar investor and super successful. He was in Tesla, he was in PayPal, he's in all kinds of, you know, great success stories. So these guys, actually, this was a study they did of his brain, not of his brain, but how he makes decisions. And this, so I want to caution, first of all, this is not, you should not take this as how every investor makes a decision, but what I'm going to kind of argue that every investor has something like this. So if you take, you know, the starting point for Tim is the market big? For Tim, for most VCs, they're looking for a multi-billion-dollar market, like it or not. Now, one thing I always talk about, and again, I want to touch a lot of subjects, but unfortunately can't drill too deeply. That doesn't mean that your initial MPV, you know, as you're going out, your initial target market. So we generally talk about total addressable market, TAM. Then we talk about strategic kind of attainable market, SAM. If you would get all of the customers given your resources, that's the size of your SAM. And then your SOM, your strategic obtainable market, is that market share of that SAM. So it might be 10, 15% of the SAM. So the SAM, your SOM might be 50,000 or 20,000 for your initial product. But as you grow, as you expand, you will reach out to a market that's bigger. And that's if you're going to go to venture capital in general, in particular, if you go to for top tier investors like this, you have to talk about multi-billion-dollar markets. I don't think that's anything new to anybody. But for Tim, that's the first thing he looks. He looks at the company, is the market big enough, multi-billion? If not, toss it away. If so, he's going to go to the second, to the next kind of thing. Can you make big margins? So again, this is a little bit qualitative, but generally people want to see you getting kind of significant gross margins. So this is where we start talking about unit economics. As you build up your business, what percentage of that revenue are you going to be able to take out to pay down your fixed costs and ultimately make a profit? So he really wants to look into kind of the business model at this point, and do you have a shot at being having great margins? Next, only third is the team. So generally, I'd say 70-80% of investors tend to be team driven. So team first, then idea, then market, whatever. These top tier guys like him tend to think about other stuff first, because they think if they can find a great idea with a great market, they've made so many investments, they can take a team and put it in there to do that. So that's a little bit of a risk when you're pitching ideas to major investors. Absolutely, first of all, they'll never sign an NDA, a non-disclosure agreement. So you always have to be a little bit careful about what you share. Now, that said, you won't get very far with most investors until you share a significant amount. So that's really a balancing act. But for him, he's looked for the team next, find people smarter than you. Does he believe that you can get market share that's partially driven by all of the prior things? Can you mix that team with the market and the business model to get a significant market share? This is interesting, actually a very interesting point here that gets ignored sometimes. But investors are scared. If you talk about a $1 trillion market and getting 1% of that, that's something investors do not like to hear. They'd much rather see a $100 billion market where you get 10%. In other words, there's a little bit, like I said, there's a rule of thumb that you want at least 30% ownership, or at least 70% of ownership by founders before doing Series A. There's also a rule of thumb that kind of most companies within their SAM, their strategic addressable market, we'd like to see you talking about kind of 10 to 30% market share. So on the current resources you get in this round, that you can go in there and grab 10 to 30%, because that seems like you're making an impact in that market. But it's not so much, it's not 90%, because then it becomes unrealistic. But that's what this is always a balancing act as to how you define your market. And I think sometimes startups make the, as a kind of an overreaction to the market sizing. They create such a huge addressable market in their, in their deck and their communications, and that, their growth patterns look, even while it's really high, you're still talking only 0.1%. So this is it's a balancing act. And granted, if you're a business to consumer model, absolutely, then you're probably can look at kind of single digit market shares. But in particular, if you're doing anything B2B, B2G, whatever, generally you want to kind of focus on that 10 to 30% market share, in my opinion. Then, of course, he's looking, do you have partners? So do you have people, companies, individuals, organizations that will speak on your behalf, that will say that you're a great company, your product is great. So, this is the kind of next thing he looks at. Then basically kind of this big picture, all this put together, can you become number one or number two in the market that you're addressing? And then if he believes that, he makes an investment. So that's kind of again, a look at one investor's brain. I think my opinion, it's a flawed brain, but I can't argue with his success. If you look, he's done, he's literally made tens of billions of dollars in VC. So obviously he's doing things right. To understand the fundraising kind of value proposition of the investor, this is the classic kind of empathy, design thinking slide. And I always say, if I am on a if I'm on a fundraising mission, so in other words, if I'm doing a kind of a roadshow or whatever, I would like to have it not to only be one founder. I'd like to have at least two people, ideally two co-founders, but also maybe somebody else on the team in all of those meetings, because I feel that often if you're by yourself, and I definitely fall victim to the same thing. If I'm by myself, I get focused on my pitch and I'm not absorbing the messages that the other side of the table is giving me. And so if you have somebody else with you that's trying to understand, kind of get the body language of that investor, kind of and steer the conversation, because I think as an entrepreneur, that's one of the kind of fundamental talents you need to develop, is to be able to read the other side of the table, move your pitch in a way that kind of goes towards where you see that investor wanting. It means a lot of homework. Again, I'm going to show a little bit about that moment. But it also really a deep thinking about having empathy for what the investors are looking for. And to that point, they're looking for returns. They're looking for social value of having investing in a company that is consistent with their own values and beliefs. Now, I'm not only saying, today, kind of environmental, social governance, ESG, a lot of investors go on, have a big ESG policy or impact policy. But that's not only for those investors, it's also for people that are purely doing business processes or consumer whatever. You want to just find investors that align with your vision and understand how they're feeling, and try to build your pitch into their approach. Another critical aspect is the lead investor. So a typical problem to a startup's fundraising process is, you got a lot of investors that are pretty interested and say, well, if you're raising 300,000 euros, if you get to 250,000, I'll put in 50, or I'll put in 20 or whatever. So you get a lot of passive investors saying, yeah, this is good, but then you don't find that active, excited lead investor. So in general, most rounds are going to have one investor that will have both the kind of majority make a significant part of the investment, as well as kind of take the intellectual lead. So really dig in, understand the business. So the interesting thing is, what does an investor look like? Lead investor look like? It's somebody that actually you don't have to end up pushing, that they're actually pushing you. So that's now. That's really lucky when it happens. When you feel that, you're already in a small class of of startups, because again, in general, the pre-seed rounds, like someone mentioned earlier, when you're pre-revenue, don't really have a complete product, definitely is going to be a lot of you pushing. But eventually, get somebody on the hook. They will push you for data, for information. So in my kind of, what does a lead investor look like? It looks like somebody that really has that budget. When you're selling your product, you're always looking for who has the budget, right? Who has a decision-making capacity. You're looking for somebody that has a budget, meaning they're ready to invest, and they can drive a decision either as an individual, as an angel investor, or within a partnership as a venture capital investor. And then, so like I said, a lot of, at least half of the rounds get stuck without a lead investor. So again, you go out, you're just telling the story. I've got all this money, but I don't have the lead investor. Generally, the lead investor, is a rule of thumb, is going to invest 25 up to 50% of the capital required. There are definitely exceptions to this. for example, I mean, if the angel doesn't have that much capital, so maybe if it's a 300,000 euro round, maybe they're going to invest 10 or 15,000, but they really want to take an active role. They know the business. They simply don't have the net worth of a larger investor. Sometimes it makes sense to bring that type of a kind of an angel on early, work with them to build out your message and reach out to the investor community. But by and large, once you get to a substantial pre-seed or seed round, so when I say substantial, in the hundreds of thousands or millions of euros, you're looking for investors that can potentially do 25 to 50%. Once you really get to that 50%, investors are like, I don't know, lemmings or whatever, that they follow. There's a big FOMO that hits, fear of missing out. So once there's a lead investor with, that's ready to put significant amount of money in, you find a lot of people coming out of the woodwork that are willing to put money in because they just don't want to miss out. So that's a big benchmark when you can get kind of half of that capital up. Rules of thumb in Finland: pre-seed stage is less than €1 million. If it's a pre-seed stage company, meaning no customers or significant customers yet, a unfinished but promising product, with a less than €1 million need, usually you're looking at the angel community. At 1 to 5 million, that's more like a seed round, and that's going towards VCs. But there are a lot of VCs. If you're hot, then a lot of VCs still want to come in at a pre-seed level. So I wouldn't just only focus on angels, because again, sometimes your home run will be getting in a VC. So I'll talk more about that in a minute. The lead investor really helps to direct traffic. So they come on, they commit, they say, yes, we're in. It's no more of this, well, if somebody invests, I'll put money in, or if you get this much money, I'll put in. It's more like, okay, my money's ready, I'm ready to go, let's get everybody else. And they're rallying people.
Hello, my name is Elias. Thank you for the session, William, so far. It has been great. A quick question.
Yes.
We are on pre-seed stage, and I'm interested, how do you make an evaluation of your project in such an early age when you don't have any, or you don't have a lot of sales?
Yep.
So, yeah.
Okay, super question. And it's I'm going to go back to the arts, philosophy, and whatever. So I'm going to show, actually, if we go back to I'm going to share here. So first of all, audio okay now? Okay, good. So, and I'm sharing. So, right. So here's how I do it. And here's how we do it in my firm. And I think this is the way most venture capitalists do it, one way or the other. Now, everybody has a different, like I showed you the brain. So they're different brains of venture capitalists. And so here's a good example of one. So if I look at how our brain works as a firm and also as an individual, I actually do use this. It's a tool that's been created by an organization in US called Seraph. And it's basically, let me make it a little smaller. So the idea here is, and this is very important, this gets to my original point about why you need to think about not only how much money you need now, but how much money you're going to need over time. Because basically, I'm going to look at three things. I'm going to look at the current deal environment. So I'm going to look at the current deal environment. I'm going to look at the financing requirements going forward. And I'm going to look at the exit potential of your company. And I'm going to basically every company that I look at, I effectively go through this checklist of, it's 36 different attributes. and it's in here. It's the number 11, the serif val, and so I think this is a superset of every factor any investor is ever going to be able to look at. It wants to look at. The reason it's arranged like this is because what I'm effectively interested in 3 time periods. I'm interested in what the market is like now. I'm interested in what's going to happen once my money's in until we exit, basically. And then I'm interested in what's going to be going on in the market when the exit happens. So when I teach this from a financial perspective, I always talk about discounted cash flow, and the true value of any company is the expected value of the future cash flow discounted back to present based on the risk level. The problem is, for a startup, you have no idea what the future revenues are. You have no idea what the future costs are going to be, and you have no idea how risky it is, right? So all these ideas of building a spreadsheet, a forecast through 10 years or whatever, and then discounting all that back and coming up with a value, it's a pipe dream. You can't do it. But I'll talk about, you still need to forecast, but you can't really use that for valuation. So what we do, but generally as venture capitalists and angels or whatever, is we look at a bunch of different factors that we think are correlated with the current deal environment, with what's going to be happening, what's going to determine how much future financing you need and how much exit potential. So, and this is a lot of stuff. So you can think, and sometimes it's not, there's no necessarily right or wrong where you take all these factors and put them. But for example, margin levels important for the financing requirements, because if you've got high margins, you're probably going to need less future venture investment. So that makes me happy, right? As an investor, I put my money in, you're going to need less other investor money in. So I will keep my percentage pretty close. Same is if there's an early exit potential, if you have like some good partnerships that, if the market doesn't evolve like we like, could possibly sell the company in a few years, that also gets to requirements. And you can look at all of these, and all of these basically are elements of a business model, right? So what I do is I look at every company, and I start out, obviously, when I first meet you, I can't figure out all of this stuff. But by the time I make an investment, I do want to rate you. And basically what I do here is rate everybody from 1 to 10, 1 being worst, 10 being best. And I basically use this kind of average level to help me figure out, actually, if I average all these together, I get 5.8. Generally, when I'm making an investment in a company, I want this to be at least 6, 7, 8. So everybody has their own kind of way of looking at it. But you always have to keep this in mind. You can be a perfectly good company, but still not be an attractive investment target, because only a small fraction of companies get investments. So you have to find, so my advice from this, I love this from a sense that it's complicated, but it's a superset. And by the way, the links that are in here are really excellent. So you can go into each of these, and there's a little blog post about that gives background on at least one way to look at that particular attribute. But what this helps me do is to make sure I don't miss anything. So I will go in, I'll kind of throw this model at everybody. I will kind of throw away, I look at about 500-600 deals a year, and I think that's quite common for early stage investors. So I will only, bring forward probably 1 or 2 in 10 companies to a next meeting. And those are generally ones where, again, first meeting, maybe I've only filled out 3 or a handful of these factors, but I found something that's really amazing in it. Like in this case, I don't remember, but what this particular case was, but if it had some outstanding attributes that, really great go-to-market strategy, or, the lead investor is highly credible, somebody I'd like to go in with. These are the kind of things that will push me forward. So, I mean, to your point, I do look at forecasts, so I'm definitely going to always sit down with you at some point and look at what do you think revenues are going to be this year, next year, following years? What are expenses? What are customer acquisition costs? You know, what's the lifetime value of customers? So I'll definitely look at all of that stuff. But that's more after I've kind of made this qualitative look at a company to see if I want to go forward. Due diligence process is really a place for you to show your professionalism. And so while I showed a set of Google Docs, it's much better to use a professional approach, or if you're using Google Docs, that's fine too, but do it in a way that is restricted. So again, because once we're actually interested, we're looking at everything you do as a signal about the way you're going to do business, the way you're going to manage our money going forward. So I didn't hear what Tapio said, but I can imagine he was pointing to a few tools. I think it's really important to be able to do that professionally. And the second thing you get out of that, I assume, in that platform or most platforms, is you can see if the investors opened what you've done, what you've given them. Huge tell on the investors' motivation level is how quickly they dig into what the stuff you send them. So, you know, it's great. So unfortunately, if you do a Google Doc, there's plenty of security issues that might be there at the end of the day. But the other thing is you simply don't get any insight into whether investors are actually moving forward, going through the process. Generally, by the time I get to my due diligence, we've already agreed with the founders what the terms are going to be. And then, you know, more or less what I do is I do it was generally a 20 to 30 page document, Word or, you know, Google Doc, where I basically go in and interview founders and other key team members and try to come up with answers to all of these questions. Because that as a lead investor, which I generally am, it gives me the ability to actually share your thinking with the other investors, as well as my thinking. You know, often exit strategy becomes to be a key component. Now, another common question from founders is, should I talk about the exit strategy? And as always, there are multiple schools of thought on that. The thing you always have to be aware of with angel or VC is generally we never expect to we expect to put money in now, maybe put more in later, and then get one big payoff in the future when you either sell the company or do an initial public offering. We don't expect to ever, for example, get dividends or interests or whatever. We're going to get, we're going to put money in, we're going to get money at the end of the line. So we're very interested in what's the exit potential of your company. Now, as a founder, it's a tricky question because we don't want to see you focused on exits, right? We want to see you focused on building the business. However, at least personally, I always wanted to sit down with you and say, who do you think are the most likely acquirers? Why are you disrupting an industry to the level that somebody is going to be motivated to buy you? Because again, just being a nice, profitable, reasonably growing company, that's a license to a good but not great exit. The license to a great exit is that you're really disrupting and making the existing players play differently. So I always like to hear that, what are those scenarios where the big, those big robust players are fighting to get you. That's actually when I sold my company in 2010. I sold a software company, and we had two companies fighting over us, and that was actually what drove the valuation of our company at the end of the day. We had a couple million of sales, a little bit of profits, reasonable growth rate, but we had a very strategic product for what we thought are 3 or 4 different players. We went to all of those. 2 of them decided that they really wanted us. We were able to play those off of each other and really doubled the valuation of our exit based on that, strategic discussion between, potential competitors in the market. So, but what I love about this is I can, like I said, I think in dashboards, so I can look at here immediately and see here are all the kind of issues that I'm going to have to answer to when I'm raising money. And granted, a lot of times investors aren't only going to go through a handful of these. But the thing is, you never know which handful are the ones that are most important to the investors you're talking to. So it's always much better to be able to really kind of look at it across the board, have decent answers to all of these. Maybe another kind of hint in the due diligence process is the more that you can help the investor, the better. So like we're doing one right now, and the team, the finance, it's a small team, 12, well, actually 15 people. So a reasonable size for, this is a seed investment we're going after. But they prepared out the data room very completely. And the investors basically didn't have to do anything but go in there, start reviewing documents, start asking questions. The nightmare is where the investor has to keep asking you and say, well, why isn't, you have 30 employees, or you have 10, 15 employees, why are there only 11 employment contracts here? Okay, well, that's a signal that you're not thorough. The best deals are lost because you've not handled investors right in early phases. So I'm answering more the question is, what do you need early on? So first thing is, we're talking about kind of setting up a fundraising process. The best deals I've ever done have been come out when we weren't raising money. So actually, when we do a great press release about a new customer, or a Twitter post about some milestone, the millionth user or whatever it might be. But investors are tracking this stuff. So the best investors have their crawlers out all the time, and they have analysts working that are actually contacting customers and looking for exceptions. So they're looking for companies that kind of show up on their radar screen that they can get access to before everybody else does. That's the way Finnish investors work, and that's the way global investors work. So I really advise you that once you're ready to start sharing your success stories, get a social media plan. In particular now, before it was like, okay, before COVID, it was figure out the 5 best conferences for your sector to go get visibility in. Now, of course, online events are important. Physical events start becoming important again, but it's really highlighted, in particular LinkedIn. So I find LinkedIn being the best driver of inbound investor leads, but also, but if you have visual stuff, Instagram, Twitter, whatever. But just always have hooks out there that you can, and kind of where investors can pick up and contact you. Because again, best time to raise money is when you don't need it, honestly. The worst time is when you're desperate. And again, most of what I'm talking about here is when you're not desperate yet, but you realize you're going to have to concretely go out there and raise money. So having a one-pager, very important. Again, investors have, I heard, actually one of my partners, actually Bruce Orrick, who's former ambassador to the US, is one of my partners, or sorry, US ambassador to Finland is one of my partners. And his claim is that the attention span of a goldfish is 9 seconds, and the human investor is more like 6 or 7 seconds. So you have a very limited time to actually get people's attention. It's a little bit facetious, but having a one-pager that's descriptive, again, DLM has examples for that, is good. Some people, there's just form-based one-pagers that are okay. Personally, I'd like to see something visual, a little bit about your brand, or something that's captures my attention a little bit more than just a bunch of bullet points. But having a one-pager that describes the company is important. Then I look for, it doesn't have to be 10-page, but a short pitch deck with the problem, solution, competition, stuff like that. So there are, a million examples of those. But a short pitch deck, generally what I get, if a startup's contacting me, I either get a one-pager or a short deck. And often, more and more often now, they are in links as opposed to PDFs. But PDFs are just fine. I think people are using PDFs a lot these days. But I generally get an email with this in short explanation of the company, suggesting a meeting. Then ultimately, you either need a full business plan or a long pitch deck, so with a lot of more detail. So this is something that you'll go through within the investor in the second, third, fourth meeting. But this first pitch deck is really something to catch their interest. Financial forecasts are super important. So I have some models also in the links. Generally, what I like to see is a 3 to 5 year forecast of what your optimal vision calls for. So, meaning I just said that we can't predict the future, right? So some people take from that the idea that it's not worth making long-term forecasts. The reason you want to do it is because it helps you get a shared vision with the investor. And so when I see early on, first of all, if I see no financial numbers in terms of forecasts at any level in the initial pitch deck, it's really a turnoff. If it's exciting enough, then I will look further. But I would like to see something that says, okay, we have now sat down. We think that we can be at 10 million in sales in 3 years, or 100 million, whatever your number might be. But the point behind the forecast is it's not that it's a truthful document we're going to make a valuation off of. It's really something where I can press you to explain to me your business model and why you think you can be a leader in the industry. So I'm a big believer in financial forecasts. I'm a big believer, if you're a small team without a CFO, I am a believer in having somebody outsourced to help you with that. If you don't have the talent on the team. I'm also pretty famous for bringing in, kind of master students from the business schools or whatever to help with that. I love working with interns and stuff like that. So anyway, I'm a big believer in the forecast, and I think most investors will ask you to have these forecasts before they put money in. Super important is how you're going to use the money. So that's often a gotcha at the end of the day that okay, we want €500,000 to do some marketing and R&D. Well, that's not enough. So you want to have a detailed kind of list of the things you're going to spend the money on, and good explanation of why you're going to spend money in kind of one part of the company versus another. So I often the use of proceeds to me are too broad. So you want to be pretty specific how you're going to spend the funding. You definitely want to create a list of target investors. So in the sheet that I've shared with you, there is there's a tool for that, but you can do it however you want it. Honestly, almost all of my companies are doing this with Google Sheets right now. So they're taking one of these models, they're sharing it with their close in, amongst the co-founders, amongst the board members, strategic advisors, or whatever. And they're creating again, they go in and they record when there's a meeting, and they record when, what the responses from the investors are. So they're really pretty sophisticated about tracking that. There are some tools there as well. You probably followed Rundit. There's something called, there are a number of different tools that I've not used a lot, but that's kind of growing as there's SaaS tools that you can record your kind of monthly, actually it's not SaaS tools I'm speaking more towards the kind of investor updates, but you can kind of update your forecasts monthly with actuals and share those with investors through different platforms. So list of target investors, just very important to handle this like any sales process. Manage, reach, you've got prospects, suspects, and just bring them along and be able to share on your team where they stand. And we'll go back to the workbook one more time to kind of look at that quickly. Yeah, then super important is, and I'd say if there's anything that catalyzes a deal more than anything else, is if you have a reference customer, partner, influencer that really believes and uses your product, that's willing to do reference calls with investors early. As soon as I can get beyond your story and start corroborating the opportunity here with multiple outside players that are not necessarily on your team, the better comfort I get that I can actually start my process. So this is, my kind of list of 6 or 7 things that I would create very early. Not necessarily in this order, but you need all of that. So thinking about this number helps me say, when I'm my personal is a personal investor, and not so much with my funds, we all have different levels, but I love to see companies that have a way to be profitable and high growth with between 3 and 10 million euros. So if you come and say you need 50 million euros, to me, it's probably, I think I don't have enough money to support that, because what we look at is, if you're a very small investor, this gets, when I looked at ICEYE, for example, very early, the satellite company, I loved the company. It was so perfect. I really wanted to invest, but I knew it was going to need hundreds of millions of euros. I said, that's just not for me. If I can put in 30, 50, 70,000 euros, at the end of the day, I'm going to own 0.0001% of the company. Now, if it's ICEYE, I would have still made out great. I should have done it. But when I looked at it, I said that was my rationale for not doing it. It needed too much capital. On the other hand, there are many investors that have deeper pockets, generally fund investors, that want to see you raise a lot of money. So they want to see you with that 50 million or 100 million. If you're going to Lifelines, if you're going to some of the bigger VCs in Finland, they want to see, you ready to raise more money. So I'll challenge you about that number.